Hello, everyone. Welcome to another Webinar Wednesday by Smartkarma. I'm Michael Tegos. Today, we have the pleasure of welcoming Insight Provider Jason Yap, who will share his insights on forensic accounting and how to apply it to the investment process. Jason is an independent forensic analyst with 11 years of experience, and he was previously a senior forensic analyst at a Singapore and Shanghai-based fund with approximately 2.5 billion in AUM. Jason, thank you very much for being with us today. Let's get right to it.
All right, thanks, Michael. Hi all, and thanks for attending today's webinar late in the afternoon. I believe most of you will be relatively new to the concept of forensic accounting. So for this presentation, it will not be a technical presentation. And as far as I can, I'll try to make it as relatable to your day-to-day investment work. And second, by the end of this webinar, I hope each of you would have a handful of forensic accounting takeaways that you can immediately apply to your investment work. So today's webinar will be split into three parts. First, what is forensic accounting? Second, how is it relevant to investments, where I'll list out a problem statement from the perspective of investors. And I will also highlight some notable investors who have applied forensic accounting to their investment process. And lastly, we'll delve into some specific approaches and methods to identify accounting and governance shenanigans, so-called. And finally, we'll end off to discuss briefly about what it ultimately means for your portfolio, the portfolio implications. So before that, just a short introduction, adding on to what Michael said. So I've started this company, Logos Advisors. It's essentially an investment research company that focuses on forensic accounting. 11 years of experience in both forensic accounting and investments. This includes 3 years in Beijing, where I did forensic engagements on Chinese companies. So forensic accounting, to put it in simple terms, is just a combination of investigative skill sets together with financial and accounting expertise. Traditionally, in an accounting firm, it's used to investigate fraud and, for example, embezzlement cases, and ultimately to present the findings to, say, an audit committee or the court. Of course, in recent years, there's an increasing prevalence of fund managers incorporating forensic accounting and investigative research techniques into their investment process, to the extent that apart from traditional analysts, they're hiring forensic accountants and investigative journalists. There's two key differences between these two types, in the sense that for the traditional forensic accounting, it's usually post-fact when fraud has already happened and you just need to substantiate your findings. And two is because your appointment is through a court appointment or through the audit committee appointment, you typically have better access to information and also access to management. Whereas for forensic accounting in the investment space, it's usually outside in. They're trying to analyze the business from a forensic accounting perspective using only public information. And also it's sort of preemptive rather than a post-fact approach. Moving on, there's two main types of fraud: financial misstatement and asset misappropriation. For those who are familiar, there's actually a third, bribery and corruption, but this has a relatively less direct impact on financial statements, which is what the investors are concerned about. Even if there were, it's usually bribery and corruption would be a precursor to the financial misstatement and asset misappropriation that follow. So one simple way to understand how to incorporate forensic accounting investments is essentially a risk-based framework where you do analysis to identify the risk, you determine or evaluate the likelihood of occurrence, and ultimately you try to determine a so-called quantum or the significance to the organization. And I think it will be very demanding for you guys and even for forensic accounting experts to look at certain information and say, for certain, there's fraud. So in the investment perspective, what we want to arrive at is actually determining whether there's credible risk of fraud rather than fraud per se. And when credible risk of fraud is determined, then it becomes an iterative process where you might want to escalate your investigative work, or you may want to engage management to find out more details. And just quickly, a typical conceptual framework we use is the fraud triangle. I won't go into detail, but essentially it's the three parts here: pressure, opportunity, rationalization. Pressure when there's shareholder pressure, for instance, pressure from creditors. Opportunity relates to where there's internal control deficiencies, or where there's a very dominant founder which leads to management override of operational level decisions. And lastly, rationalization. Something interesting is typically in a massive fraud, the fraudster would insist that everything is justifiable, I have done nothing wrong. So this is typically the mental state that they find themselves in at the end of the day. So the problem statement here, just to put it very simply, I hope I'm not being too simplistic here, is investors rely on financial statement analysis to make investment decisions. But we've seen Luckin Coffee, we've seen Wirecard that has shown that the financial statements, even audited ones, can be materially misstated. So this leads to unreliable data that you base your analysis on. And accounting red flags that can be reviewed through analysis are ignored and management not held accountable. And ultimately, there's missed opportunities to generate excess investment returns. And perhaps something more of concern for investors is it doesn't necessarily work to the effect that fraudsters just want as high as possible revenue or earnings. Because as you guys are fully aware, sell-side analysts, buy-side analysts, they follow the growth trajectory very closely. So sometimes it's about, rather than sort of maximizing revenue and earnings, it's about smoothing the pace of growth or smoothing the financial and operating metrics that people look at. For example, e-commerce companies, GMV. So just a couple of examples of notable investors. Norges Bank, Nikolai Tangen, the CEO of Norges Bank, he's a big fan of forensic accounting investments. So as you see here, he has sort of linked this application of forensic accounting to what he calls negative selection. And also, he's also brought in the concept of ESG, which makes sense because my personal opinion is because it's so overhyped these days. There's an overemphasis on environmental and social concerns, but the corporate governance aspect seems to be forgotten, or less emphasis upon. So moving on, for Norges, there's a specific example where Nikolai Tangen, he was explaining how they saw the FT report on Wirecard in early 2019. They did their own independent research and arrived at a state of credible risk, where upon which they made the decision to exit Wirecard and avoided the losses. So this is one example of how it can be applied. Two other examples, maybe something that's more familiar, is short sellers. So Heinekos, Jim Chanos, famous short seller, financial detective, trying to determine that cash did not exist and then betting on that. Something closer to home or Singapore is even GIC. This may or may not represent what they're thinking today, but this is an old sort of job posting they did, I think last year, where they wanted a forensic accountant for their public equities department. So they wanted to basically they basically wanted to determine the risks to their investments and the differences between market perception and reported figures as opposed to the economic realities. Okay, moving on, a couple of common red flags. I won't dwell into each of these because this will take too much time, but just to give a bit of a flavor, I'll talk about revenue and debt. So In terms of revenue inflation, there's two broad approaches to look at it. One is through accounting fundamentals and also industry and peer comparisons. So the first, accounting fundamentals, if you look at the revenue, every dollar increase in revenue would show itself somewhere else. So in the case here, it's receivables. If accounts receivables will be affected, the cash balance, the cash flows will be affected. So common sort of red flag is when there's a divergence in the pace of revenue growth as opposed to the cash receipts. And also you see accumulating accounts receivable position that's building up and up without any cash collections coming in at all. And then the industry and peer comparison example, sometimes it just takes a little bit of common sense, and I'd just like to raise one example here. For those who are familiar with the China landscape, there's the famous air conditioner manufacturer called Gree, helmed by this Charlie Dong. So last year, there was a lot of hype about how she managed to do 65 billion RMB in live streaming sales on, I think, TikTok in one day. But if you look at it, the nationwide air conditioner sales is around 214 million units a year. And you multiply that by the sort of average ex-factory price, 2005 to 3000, you arrive at 535 billion. So effectively, Charlie Dong managed to achieve single-handedly 1.2% of the total nationwide sales in a single day, which also means, by extension, if she just worked a little bit harder and did live streaming for another 2.5 months, she could single-handedly sell all the nationwide air conditioners by herself. So is that even possible? So things like that might trigger some red flags. And I guess the takeaway here is accounting principles are standardized and well-intentioned, but there's certainly room for companies to interpret them, and also some loopholes, although the GAAP and IFRS bodies are continually trying to keep up with things. Detection tools. So just bringing back to my introduction where I said that forensic accounting in investment setting, it's outside in and public information only. So what can we look at? So just very quickly, it's mostly self-explanatory in these couple of tables, but for instance, you can do accounting screens as a form of active fraud surveillance. No human eyeballing required, something that prompts you whenever something is detected through your screens. And at Smartkarma, there's a competent tool provided by a previous insight provider. So this could be helpful. And for those who subscribe to GMT research, they can also use the screens if it helps. Personally, I just want to sort of add a caveat that there's a very good chance of false negatives, such that 50% of the red flags they turn up may or may not be true. Then you might ask yourself, what's the point of the screens after all? So basically, never use these screens in isolation, and complement that with separate analysis, independent analysis. Second resource is earnings transcripts, or even better, listening to the call itself, so you can listen to the management's intonations and so on. I've previously written an article, the link is here, so I won't go into detail, but basically entering an earnings call and such, always have a healthy degree of skepticism, and try to pick up the metadata in the sense that sometimes any word additions, deletions, or omissions compared to the historical quarters might actually have a significance. Next is exchange filings, which includes your financial statements and every other company announcements, industry peer group analysis, etc., and auditor reservations and qualified opinions, transaction document analysis and so on. Another thing that might be interesting is short seller reports. So instead of betting against the ideas thrown, I want to put myself in the shoes of I'm along in, for instance, Evergrande, and there's a short seller report. So do I trust this report or not? So what is usually best practice is to do an independent assessment of the short seller report and the methodologies. And you might even want to reperform the investigative procedures. And in recent times, the likes of Money Waters and Citron Research are becoming more sophisticated in the sense that they're doing sort of digital forensics, like tracking the APIs, tracking the bots that attend the classes for GSX, for those who have read the recent, not recent, but last year's news. So things like that, you might want to equip yourself with these capabilities to do this reperformance. Next is company searches. This, I think, two main aspects. One is to see if there's any legal situation. Sometimes it shows up in company searches, and sometimes it's also good for you to pick out related party transactions, such as key appointment holders between the company's suppliers and the company. These are usually a bit of a red flag. Lastly, sentiment analysis. Many tools out there today, mainstream media reports, social media. So might want to pick up the details from there. So ultimately, the use of forensic accounting doesn't necessarily need to be to prove a fraud. It could serve the purpose of assessing the company's quality of earnings or the strength of the balance sheet, or whether there's a sort of dead time bomb ahead. So even in this context, even a low or cheap PE company can be expensive if the revenue and earnings are inflated. By extension, a low price to book can be expensive if the asset values are inflated. So, some independent evaluation might be par for the course. And then the classic saying that managers are incentivized to see the share price rise and the tenures are short. So in the time that they're with the company, they will use aggressive accounting practices to front load revenues. So something to watch out for. So ultimately, just to recap, forensic accounting would help not just for shorts, but evaluating revenue, earnings quality, the growth prospects, cash flows, corporate governance. And with that analysis, you can either resize or exit positions with significant accounting or governance risks, or you can use it as a capital allocation tool to either buy high quality companies or avoid or short low quality companies. So with that, I conclude my presentation and I open the floor for questions.
Thank you very much. Jason, I think you put it very well when you just said that even a cheap low P company can be expensive if the revenue and earnings are inflated, as your slide mentions there, which I think really kind of drives home the implications for investors. Does it feel like there's increased attention paid by investors to this particular aspect these days? Like, have we sort of learned lessons from debacles like Luckin Coffee and Wirecard?
I would say yes, there might have been. So before Luckin and Wirecard, it was a sort of a long lull when the last big fraud of note is the likes of Enron and a couple others, which is
Right.
decades ago. So, but of this Luckin Coffee incident and Wirecard definitely sort of put to fore the prospects that earnings are inflated and so on. So I think most competent analysts delve deep into the figures. They would, for instance, remove share-based compensation. They would remove one-time extraordinary income, and then use the net earnings to have a house view on the PE. So I think this awareness is definitely higher. Of course, I'm self-interested to say that there's definitely more to be done.
Absolutely. A question from the audience is, can you elaborate on related party transactions and their implications as red flags?
Related party transactions, first, there's a sort of a interest transfer between friends and family, for instance. So you always want to make sure that any transaction is at arm's length. So taking Gree, for instance, a lot of its suppliers are actually related parties, and in fact, its third largest shareholder is actually a major supplier. So, I mean, Gree was basically caught between a rock and a hard place in terms of maximizing revenue or offending the suppliers, in the sense that they have actually held off on the channel reform efforts towards moving to e-commerce. So on one hand, you're not generating the maximum value or keeping up with your peers in terms of your earnings margin, but there's another interest of protecting your relationship with the suppliers / related parties. So this is one sort of conflict that might happen. And maybe a more nefarious case is where you misappropriate funds through related companies.
Got it. Thank you for that. Another question is, how do you decide which industry or which company to spend time on? How do you prioritize companies to cover?
There's no hard and fast rule, but for me, I try to read as widely as possible, not just financial news, but also industry sector news. If you have friends in a specific shipping, oil sector, speak to them. And always try to be skeptical about what one is saying versus the other, and try to connect the dots. And usually you might come to something that says, hey, this doesn't really stack up, and you might want to do further research. So that's how I personally do it. I mean, there are people who rely on counting screens and so on, which also works.
Understood. Thank you. Another question is, are there any striking metrics or ratios that will cause you to be skeptical at a glance?
So, for instance, growth and margins, something that's out of whack with the historical growth rate and margins and their peers. It would be something that's alarming to me. But of course, if I investigate and this is justified by, for example, a new line of business that's hot, then I'll let it pass. Other than that, I like to look at the leverage solvency ratios, just to give me some assurance of their solvency and their ability to repay debts, and also the working capital conditions, which give me an indication of whether they are deferring payments to suppliers because they can't cough out the cash, or they're struggling to collect receivables from their customers, things like that.
Got it. There's a question about Evergrande, which of course is all the rage in the news right now. So with so much problems uncovered at Evergrande, have the auditors highlighted the issues sufficiently to investors?
I haven't done enough work to make a call on the auditor's work, but based on what I read in the media and so on, maybe just to share, I think one instance where the debt accumulated without being noticed may or may not be true. I read this from media reports, some Chinese media reports, that basically they had retail financial product salespersons at their property selling retail financial products, and Evergrande incorporated companies that it owed just under 50%, so it doesn't need to consolidate the associate company on its books. And then it used this associate company to rack up debts, use associate company represents itself as having an Evergrande parent guarantee, and then people buy into that. And then the funds are then channeled into Evergrande's initiatives. So the debt is essentially an off-balance sheet debt. It doesn't show up immediately on the consolidated financial statements of Evergrande, and perhaps also because of the property clamp down measures that's caused things to surface.
Got it. Thank you for that. The attendee also has a question on nanofilm. So their question is, just wonder if the recent share price drop of nanofilm is detectable, as its revenue profit dropped much below expectation. I'm not sure if you have a comment on that.
Sorry, I haven't really looked at nanofilm.
Understood. With differences in reporting and accounting across different markets, do you think that this is an extra challenge for investors and, of course, analysts basically trying to keep up?
I think if you are able to get a solid grounding on GAAP and IFRS, and also rather than reading the details of all the accounting rules, just keep up of the new changes they have introduced in recent years. That might be enough, because that will give you some direction of what kind of accounting rule arbitrage or loopholes they're trying to close. So there's two I can raise here is, for example, many companies used to use operating leases to hide debt or off-balance sheet debt, and then that's been sort of recently clamped down with the IFRS 16. So things like that. And of course, you can speak to people like me.
Absolutely. And there you have it. If there are no more questions, I would like to thank Jason very much for his time. Of course, as Jason mentioned, you can find his insights on Smartkarma. And of course, you will be able to find the forensic accounting tools that he has linked to as well. For any other questions, you can email us at research@smartkarma.com. Jason, thank you very much for taking the time to be with us today and for sharing your insights into this very fascinating subject.
All right, thank you. Thanks, Michael, and thanks to all the